Hello and welcome to our channel. If you've not visited here before, my name's Charles Delastic. I'm the Managing Director of Blue Bond Tax Planning. We've been helping clients eliminate inheritance tax for more than 18 years. And today's video, which I'm sure you'll find really useful, is how to avoid inheritance tax at zero cost. So have a look at this. If you like this video, then please give us a like below. Otherwise, we'll get straight into the video after the introduction. Okay, so as I explained, today's video is all about no cost inheritance tax solutions. So let's just get straight into it from the word go. So first of all, you can ski. Now this is my 90-year-old mother's favourite occupation, which stands for spending the kids' inheritance. So yeah, just spend the money really. It's your money, you can choose to do with it as you will. If you want to enjoy your latter years, there's no reason why you shouldn't just spend the money. And certainly it's a very effective way of reducing your inheritance tax. The next section is all around small gifts. So first of all, the very first gift we can talk about is £3,000 per year. So I say a small gift, it depends upon the value of your estate really and how much capital you have. But if you give away £3,000 per year, it doesn't seem like a lot to some people, but of course that's £6,000 every year for a married couple. And if you haven't used the allowance in the previous year, you can give away a further £3,000 each. So that means in a given year, you could give away £12,000 in 1 year, and then £3,000 a year every year thereafterwards. So as I say, over the years it can add up. So over 10 years, if you're gifting away £6,000 a year, that adds up to £60,000 outside of your estate, which if at a 40% inheritance tax saving, that's around about £24,000 saved for just giving the money away. So a useful gift asset really. So the next one's not quite as useful, but you can give away £2,500 on the marriage of your grandchildren and £5,000 on the marriage of your children. Now that's each. So obviously if your child's getting married, you're a married couple, there's £10,000. But it has to be done before the marriage takes place, and the marriage actually has to take place, but also make sure you log it so that they don't think it's part of that £3,000. So it's a separate gift, yeah? And then you've got small gifts of unlimited amount, unlimited people. So literally, I don't know, you've got a bunch of people that you play golf with and you want to give them all £250 each. Yeah, you can absolutely do that. It's not generally utilised that much, but it is an allowance. Okay, next bit, GNI. So that stands for gifts out of normal income. Now, this is a really, really useful allowance and very underutilised by most people. But it does depend upon having sufficient income, because it does have to come from income and it can't come from capital. So what's income? So property income, pension income, investment income, anything that you would be taxed for income tax purposes on your tax return is then usable via this allowance. Now, when you make the gifts, they have to be regular. So ideally you would set up a standing order from your bank account to make the gift regular on an ongoing basis. As I said, it has to come from income and not from capital. You would be best placed to document it. In other words, you write up a document. You don't need a lawyer. You just write it up and you say, I intend to make this gift for my grandchildren's education, and I'm going to pay it every quarter from now on while they're at school, and then I intend to pay it to them after they're at university. Something like that, and then the standing order gets set up and then it comes out on an ongoing basis, right? So it's documented, again, I would suggest that you also sign it, get it witnessed, and get that document saved with your wills so everybody knows where it is in case there is ever a challenge. Now, the amount of money that you can give away, which is why I'm saying it's useful, is that it's actually unlimited. We had a client who had a very, very high income stream in retirement, and literally he would give away £50,000 a year from his income because he could afford it, right? So it's a very useful allowance that you should look into utilising if you've got the income stream to afford it. So large direct gifts, now large is a relative term, but generally speaking, over £3,000 per year is counted as a large direct gift. And this is called a potentially exempt transfer. And if you can't see it very well, that's 7 years. So this is the 7-year rule. So it's a direct gift, it's a potentially exempt. Why potentially exempt? Because if you don't live the 7 years, it falls back into your estate. So it's only a potentially exempt gift, right? Now, there is, again, the amount of gifts on pets are, again, unlimited. So if you're very wealthy and you could afford to give away 5 million, you could give away 5 million. And there is no limit, right? But you still have to live the 7 years. Now, there's something on gifts that's called taper relief. Now, people get confused on this one. It only applies to gifts in excess of the nil rate band allowance, which currently is 325. So if you make a gift of £500,000, the first 325 taper relief doesn't apply to, but the 175 it does. So it only applies to gifts which exceed the nil rate band. So that's taper relief for gifts over 325,000. Right, so you can make gifts into trust. So a gift into trust is called a chargeable lifetime transfer. Now, it isn't limited, but it should be, because effectively, if you make a gift which exceeds 325,000, you pay an immediate income tax charge of 20% over the 325. So frankly, we've never done it because it doesn't make sense to me to pay immediate 20% if you don't have to. So generally limited to 325. Now be aware there are different types of trust, and therefore you need good advice here. So although I've said at zero cost, yeah, you can set up a trust, but you should take advice and you should pay for it. So also, again, one of these little anomalies that you need to be careful of, the devil's always in the detail, remember. Care, you've got to make potentially exempt transfers before you make, I beg your pardon, you've got to make chargeable lifetime transfers, the gifts into trust, before you make any potentially exempt transfers. It's to do with how the tax rules work, and it's called the 14-year rule, but basically, if you make a gift into a trust and then you make a gift into a potentially exempt transfer, say 6 years later, and then die within 7 years of the second gift, it can drag the chargeable lifetime transfer back in again. So that's called the 14-year rule. A little bit complicated. So again, get advice if you're using trusts. That's the message, because there are some tax rules in there that could catch you if you're not careful. Okay, there's £175,000 residential nil rate band. So this is a relatively new allowance, which only came in a few years ago, and each person that owns their own home, and they own that home on death, or they've registered it if they go into care, then effectively get that £175,000 allowance. But it's only usable provided that you gift that amount of money as part of the property directly to your direct descendants, so children, grandchildren, and not foster children, adopted children, I beg your pardon. Right, so it needs to be direct descendants. Now, one of the things to be careful of is that quite often you come across property where either the husband or the wife owns the property. Now, if you don't have the property split, or you can split it in different proportions, then one person may not get to use that allowance, which may be detrimental to the tax planning. So it's something, again, that needs looking at, and make sure that you do that. Okay, so Then we've got the normal 325 nil rate band allowance. Now, everybody who's a UK domicile gets this automatically, and effectively it's transferable between spouses and civil partners. So where's the extra benefit there? So if you are a widow or a widower and you've got remarried, you've got a transferable allowance with your new spouse, right? But you've also got a transferable allowance potentially from your ex-spouse. So a person who's widowed or widowered who's remarried could potentially have 3 allowances. Yeah, so that's something not to be sniffed at, because obviously 40% of 325,000 is a lot of money and therefore worth saving. So that takes some careful writing into wills and trusts to make sure that gets done. So it's not exactly free and that you need to take advice, but the allowance is available, is what I'm saying, right? So there's an extra allowance. And last but not least, there are exempt assets. So exempt assets are assets that you can buy. Now, you don't have to take advice. It would cost you some money to buy those assets, but not a huge amount. So AIM stocks are one example where you can just go directly and buy AIM stocks. It costs you the money for the stocks, obviously, but it's an asset that you own. And after 2 years, exempt assets are outside of your estate. So buying woodland and the trees that are in woodland are exempt assets. If you own part of a farm, that's an exempt asset. If you own parts of a trading company, so it's not an investment company, it has to be a trading company, then that is an exempt asset as well. You can buy plans through financial advisors, independent generally, who can advise you on plans which buy into business property relief, which buys into a range of companies. And that again, after 2 years, is outside of your estate. So although you'd pay some fees for the advice there, to be fair, with some of those plans, you can buy them directly if you choose to, but I would be very careful because, again, if it's not an area you know about, it can catch you out. But if you take all of those allowances together and your asset base is, let's just say, not that far over $1 million, and you've got the 325 each and the 175 each, that adds up to $500,000 each. So between you, you've got $1 million, and your assets look like they're just going over the top. You can be spending the excess, you could be giving the excess who gives out normal income, you could be buying some exempt assets, you could be giving money away in all sorts of different ways. But all of these methodologies enable you to reduce your estate for inheritance tax purposes. And certainly we would look to utilise this with any of our clients to make sure that we kept the costs down to mitigate their inheritance tax as much as possible. So it's all a mix about which suits people the best, that makes the most sense, really. So that's inheritance tax planning at zero cost. So I hope you found that useful. If you did, please give us a like in the bottom. You'll also find a link to our free ebook around inheritance tax. And there is also a link to a very comprehensive video guide to inheritance tax. But thank you very much for listening. Thank you, and goodbye for now. Thank you very much. Bye.